the specter of this Bitcoin conference is also probably causing some buying of Bitcoin, because people probably expect that the conference will generate a lot of publicity, a lot of hype. And so people like to buy Bitcoin into that hype so they can sell it. And it's normally a buy the rumor, sell the fact. So maybe we'll get a big dump in Bitcoin, either during or maybe just before the conference. I mean, people may try to, get ahead of it. And they may not even wait for the news to start selling. There could be a sell-off even before the conference begins. But my point was, I think it's significant that the risk appetite is waning. And you can see that, most pronouncedly in Bitcoin, which is the riskiest of all the risk assets. And so if people's appetite for risk is diminishing, you would see it there. Now, of course, while the stock market was rallying and, gold pulled back. Gold had about a 10% pullback. Gold almost got above 3,500. And this morning, it was well below 3,200. In fact, at one point overnight, gold was down about 20 or 30 bucks. And that was following about a $70 decline yesterday in gold. In fact, I was watching gold in the morning and, it was down about $15 or $20. And then over about a 2 or 3 minute period, it got clobbered by like another 50 bucks. No news, nothing happened. Somebody just decided to dump, a shitload of gold, at 6 a.m., 6:30, whatever the time was. And the price just got killed. And it pretty much stayed down all day. And then it went down a little bit more last night before it had a big reversal. Gold was up about $60 today. So about $80, $90 off of its low. And so I think today marked the bottom of the gold pullback. So I think it's over. And, gold's now, 3,200 and change. Let me see where it is now, 32.35. And I think the bottom is in. Now, it's possible we can go a little bit lower, but I don't think so. I think 3,000 is the new 2,000. If you remember when gold was above 2,000 initially, and I said 2,000 is the floor, you got to buy it. Well, now 3,000 is the floor. You got to buy it. It's, we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. When gold was at 2,000, silver was about 30. And I remember when silver first got above 30, I said, okay, 30 to silver is 2,000 to gold. And I was right in that silver didn't go back below 30, just like gold didn't go back below 2,000. But then gold went way up and silver didn't. You had a 50% rise in the price of gold, but barely a 10% rise in the price of silver. So if you missed out on $2,000 gold, just buy silver, because as far as silver is concerned, gold is still 2,000. Anyway, you can buy both metals at Schiff Gold. So just go there and fill up your cart or talk to one of my reps. It's not called Schiff Silver, but maybe I'll have to rename it one day, because I am very bullish on silver. I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1. At a minimum, my target is 50 to 1. And so at 50 to 1, that means the price of silver doubles relative to the price of gold. But that's not just going to be a double, because the price of gold is going to keep going up. So silver is going to double relative to a gold price that's much higher than the current price. Anyway, we got a quick commercial break. We'll be right back, so stick around. I got more to talk about.
All right, folks, let's get into it. There's a lot happening and not much of it makes sense, which in today's markets pretty much guarantees we're in for a bigger mess before anything actually gets better. So sit tight. First off, you've probably heard the buzz. There's this big Bitcoin conference going on, the annual circus act for the laser eyes crowd. And like clockwork, we're seeing Bitcoin get a little bit of a bump heading into it. Why? Because people are front-running the hype. They're buying the rumor. They think the conference will pump prices because of all the screaming headlines, breathless influencers, and the usual avalanche of Bitcoin fixes this nonsense. What happens after that? Simple. They sell the fact. We've seen this play out before. These things are all the same. There's a reason Wall Street has an old saying, buy the rumor, sell the news. People buy Bitcoin before the conference to get ahead of the hype. Then right when the hype train is at full speed, they quietly slip out the back door and dump it. And I wouldn't be surprised if that dump begins even before the conference officially kicks off. Smart money doesn't wait for the crowd to start selling. They sell to the crowd. Now, am I saying Bitcoin is going to zero tomorrow? Number, but it's acting exactly like what it is, a high-risk, speculative asset. And when the risk appetite starts drying up, you'll see it there first. Bitcoin is the canary in the coal mine. It's the most leveraged expression of speculative euphoria in modern finance. So when that risk appetite starts to fade, and we're seeing signs of that, you don't need a Bloomberg terminal to figure out what's next. Meanwhile, while the crypto kids were polishing their NFTs and counting their Satoshis, the real story this week was in gold, a story the mainstream financial media mostly missed or deliberately ignored. Let me walk you through what happened. Gold was on a tear. It had almost hit $3,500. That's not a typo. It was flirting with $3,500. A solid run, right? Then out of nowhere, in the span of 2 days, gold drops by over $100. In fact, at one point overnight, it was down $20 or $30. Then, boom, a mystery seller shows up around 6:30 in the morning and hammers the market. Gold gets smashed by another $50 in literally a few minutes. No news, no announcement. Just a giant seller dumping contracts like they were holding Enron in 2001. And we're supposed to believe that was just normal market behavior? Please, who does that? Who dumps that much gold into a thinly traded market at 6 a.m.? It wasn't a profit-taking hedge fund, I can tell you that. That was either coordinated selling or someone trying to deliberately smash the price, possibly to set up a large long position at a lower level. Or maybe it was just your friendly neighborhood central bank sending a not-so-subtle message. Don't get too excited about gold. But guess what? It didn't last. Gold reversed, hard. By the end of the day, it clawed back $60 of that drop. That kind of reversal is not weak hands panicking. That's strong hands stepping in to buy. That's conviction. So yes, gold had a correction, about 10%. But I'm telling you right now, that correction is over. In fact, I think today, the day of that big bounce, marked the bottom of this pullback. You want to know what the new floor is for gold? It's $3,000. We're not going back below that. Mark my words, I said it when gold broke $2,000. This is the new floor. Get in. And I was right. We never looked back. Now I'm telling you again, $3,000 is the new $2,000. You want to get in before we hit $4,500? You better act now. I mean, think about it. We went from $2,000 to $3,000. That's a 50% move. Another 50% gets us to $4,500. And from where we are now, around $3,200, we're way closer to $3,000 than $4,500. So this is the buying zone. But let me tell you where the real opportunity is. And it's not in gold. It's in silver. Yes, gold's going higher. But silver? Silver's going vertical. Look, when gold was at $2,000, silver was at $30. And I said at the time, $30 silver is $2,000 gold. That was the relationship, a psychological and technical support level. Silver briefly dipped under $30, but for the most part it held. And gold kept rising, now at $3,200. But silver? It barely moved. It's at $32.70 right now. That's just a 10% move. Gold did 50%. You do the math. If you missed gold at $2,000, just buy silver. Because in terms of relative value, silver is still pricing gold at $2,000. The silver market hasn't caught up yet, but it will. Historically, the gold-to-silver ratio tends to compress in precious metals bull markets. Right now, it's about 100 to 1, give or take. That's extreme. If we revert even to 50 to 1, my minimum target, silver doubles relative to gold. But remember, gold isn't staying flat. It's going to rise, so silver will double relative to a higher base price. That means triple-digit silver.
You're going to have to pony up more money, which is going to be a problem considering how broke most Americans are and how heavily indebted they are. But trade is not going to completely grind to a halt, which is what the markets were bracing for when the tariffs were 145%, and it was 125% going in the other direction. So the markets had this relief rally. But I think investors are missing out on the big picture here, because the tariffs aren't really the problem. I mean, they were a problem, but they're not the problem. The real problem is the trend of de-dollarization and the dollar's status as the world's reserve currency in jeopardy, because we have certainly brought the dollar status to the forefront, I think, in a bigger way than Biden did with the Russia sanction. I mean, that was certainly a slap in the face, an alarm bell, warning to the rest of the world. Hey, you got to get out of dollar, because that is, your vulnerability. To the extent that you're dependent on the dollar, you leave yourself open to U.S. retaliation in the form of a sanction. And so that sent the message that was received loud and clear: hold dollars at your own peril. But I think what Donald Trump has done has really, taken it up quite a few notches by threatening all kinds of tariffs on countries. And, to the extent that you allow yourself to export so much to the United States without importing, and you have these huge trade surpluses, and you therefore are obligated to accumulate dollar assets on foreign holders of our treasuries rather than domestic holders, who obviously, can vote and would not be too happy about, not getting their money back. But the Chinese can't vote in our elections. And so I think that this trend is now accelerating to get out of the dollar, and not just the dollar, but dollar denominated assets. So bonds, stocks, and in fact, the stock market has recovered, all of its losses, but not the bond market. On Liberation Day, the yield on a 10-year treasury was under 4%. Today, it's almost 4.5%. In fact, yesterday, it closed at 4.54. We had a bit of a rally today in the treasury market, and so the yields are back below 4.5%, but they're not that far below. We're at 4.44 on a 10-year. So hardly any of the loss has been recovered. Same thing for the 30-year. 30-year was below 4.5, and now it's almost 5. It closed at 4.9. It was, I think, 4.97 yesterday. And so the relief rally in the stock market did not spill over into the bond market. And that is a huge vulnerability, not just for the U.S. economy, but for the stock market rally. Because if the bond market really rolls over, if we break decisively above 4.5 in the yield on the 10-year, which is breaking down. Remember, that's when Trump initially paused the first round of tariffs, not the Chinese pause, but the initial pause. It was because he said the bond market was getting a bit yippy. Well, it's yippy yappy, right? It's still, doing what it was doing. It's just not as quick. It was a sharp collapse back then, but now it's back at the same level. And I think it's getting ready for another sharp collapse. I think the yield on a 10-year treasury can move from 4.5 to 5 very, very quickly. And that's going to be a big problem, especially when Donald Trump has made it clear in his entire administration that one of their main goals is to bring down interest rates. Well, interest rates are going up. And even if Powell caves and cuts short-term interest rates.
All right, let's pick up where we left off. Now that we've established that $3,000 is the new floor for gold and $30 is the new line in the sand for silver, let's talk about what's actually driving these markets underneath the surface. Because what's happening isn't just a commodity story, it's a global confidence crisis unfolding in slow motion. Look around. The US is drowning in debt, over $35 trillion and growing. That's not even counting unfunded liabilities like Social Security and Medicare. We're running trillion-dollar quarterly deficits, and the only way we're covering that is by issuing more treasury debt and pretending someone wants it. But here's the truth, nobody does. Foreign central banks are net sellers of treasuries. Japan, our largest creditor, is selling to defend the yen. China's unwinding its holdings for geopolitical and domestic stability reasons. Even longtime allies are reducing exposure. And who's left buying? The Federal Reserve. They're monetizing the debt. Plain and simple, They try to dance around it with technical terms like quantitative easing or balance sheet operations. But it's just money printing. Dress it up however you want, but if your central bank is buying your debt with money it just created, that's monetary alchemy. That's what banana republics do right before the currency collapses. That's why central banks, the same institutions that used to treat gold as a barbarous relic, are now buying it hand over fist. In 2023 and 2024, global central banks accumulated more gold than at any time in the last 50 years. Think about that. The very institutions managing fiat currencies are hedging against their own policies. That should terrify people, but it's mostly being ignored. You won't hear Jim Cramer talking about it on CNBC. He's too busy telling you Nvidia is the new Apple and crypto is the new gold. Let me tell you something that no one in mainstream media will say out loud. Gold is not rising because of war or even inflation alone. It's rising because trust in fiat currencies is quietly evaporating. The entire system is running on fumes, confidence, inertia, and denial. And let's be honest, the only reason the system hasn't blown up already is because there's no alternative. The dollar is the cleanest dirty shirt in the hamper. The euro is structurally flawed. The yen is comatose. The yuan is manipulated. Bitcoin? Still too volatile to be anything more than a speculative side bet. But gold? Gold is neutral. Gold is honest. It doesn't require faith in a government or a central bank. It's no one's liability. It just is. And as the system continues to wobble, that's where capital goes. Quietly, cautiously, but inevitably. Now, while all this is going on, inflation is not dead. Don't let the talking heads convince you otherwise. The CPI is a politically massaged number. They've changed the calculation so many times it doesn't even resemble reality anymore. It's like weighing yourself while holding in your stomach and standing on one leg. Sure, the number's lower, but you're still out of shape. Real inflation, the kind you feel at the grocery store, the gas pump, your rent, that's still raging. Just ask the average American family trying to make ends meet. Wages are flat in real terms, debt levels are exploding, and savings have been drained. And the Fed? They're pretending they can hike rates forever without consequence. But they can't. Every rate hike blows a bigger hole in the government's budget. Every quarter-point increase costs hundreds of billions in interest payments. Eventually something breaks, and when it does, they'll cut again. They'll print again, and inflation will roar back with a vengeance. That's when gold, and especially silver, will melt upward. Now let's come back to silver. Why do I keep pounding the table on it? Because silver is still the most undervalued monetary asset in the world, and almost nobody is talking about it. The gold-silver ratio is still over 90-1. Historically, during major precious metals bull markets, that ratio compresses to 40 or even 30-1. In the 1980 spike, it dropped below 20. So if we're at 3,200 gold and silver is still 32, that's insanity. That means either silver is going to catch up or gold is going to fall off a cliff. And guess what? Gold isn't going anywhere but up. So the only logical conclusion is that silver is going to explode. You're talking about a move from 32 to 80 just to restore the 40-1 ratio, and likely 100 or more if gold breaks through $4,000 as I expect. But it's not just about ratios, it's about supply dynamics. Over 80% of silver production comes as a byproduct of other mining. Copper, lead, zinc, gold. So if those markets slow down, as they're doing now due to economic contraction, silver production drops even if demand stays high. That makes silver uniquely vulnerable to supply shocks and uniquely responsive to investment demand. On the demand side, silver isn't just an inflation hedge. It's critical to solar panels, electric vehicles, 5G infrastructure, and medical tech. That means it straddles two worlds, industrial utility and monetary insurance. And there is no other asset in the world like that. So let me ask, what happens when industrial demand stays strong and investment demand suddenly soars? You get a melt-up. You get a supply crunch. You get silver spiking $10 in a week while the dealers are backlogged. The premiums go vertical, and everyone is calling in at the same time asking, Can I still buy silver? And the answer will be, sure, but not at $32. This is what happened in 2010 to 2011. Silver went from $18 to $49 in less than a year. And then it was over. You had to already own it. That's how these moves work. You don't chase silver, you front-run silver. Now let me throw in one last kicker, the retail silver shortage. Even today, premiums on physical silver are still elevated. Why? Because the physical market is not the paper market. The COMEX price doesn't reflect retail availability. You can have silver at $32 and still pay $38 or $40 just to get a coin in your hand. That tells you the paper price is disconnected. And that's exactly how bull markets begin. When physical demand exceeds deliverable supply, something breaks. You either get a short squeeze or you get a market-wide repricing. And we're already hearing whispers about big funds standing for delivery. Just like we saw with gold over the past couple of years. This is the kind of thing you need to be ahead of. Not chasing, not buying the top. You want to own silver before it becomes the front page story. You know, a lot of people missed the move from 2,000 to 3,200 gold. And they're asking, did I miss it? The answer is, maybe for gold. But silver hasn't even started. If gold were still $2,000, silver's price today would make sense. But gold is 60% higher, and silver barely budged. That's not a weakness. That's a setup. So here's what I'm doing. I'm buying silver, and I'm holding it. And I'm telling anyone who'll listen, clients, friends, you watching right now, this is the last calm before the storm. We've got debt exploding, inflation being manipulated but not tamed, currencies losing credibility, and central banks quietly buying gold while telling you to trust the system. And you think silver is going to just sit at $32? Come on, this is the most asymmetrical opportunity in the entire market. And when silver finally does what it's done before, when it does what it's destined to do, the gains won't be linear. They'll be vertical. And just like in 2011, only the early birds will catch the worm. So get it now, while the market's asleep, before the headlines, before the frenzy, before the panic. Because when the public finally wakes up to silver, there won't be enough to go around.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.